Okay, good afternoon everyone. Relatively as anticipated, I suppose. Can't really expect too much more on an early non-farm payrolls day. Just a quick scan across the markets then before we get to the actual number of non-farm payrolls. Volume at the minute, 230,000. It is pretty low. I mean, obviously yesterday the volume was fairly low as well, but spiked up towards the afternoon. So again, this afternoon session could bring in that flood of activity, especially with the figures. But volume pretty low, and what we're looking at is a filling out of this area from yesterday. Now, for those of you that are familiar with market profile, with auction theory, and the balancing that the market does, I mean, we see this fairly often. It's also a little bit of what I was speaking about in terms of the euro as well, where we have these moves, the market gets to an area, and then the lower volume areas that were left behind from that previous day need to be balanced out, need to be filled, and this is what we're seeing here this morning, where we have pushed a little bit lower. We dropped right down onto this 50%. It's funny, we were talking about this area this morning. 29s, of course, being the M-print swing. It's an old close. It's around the 50%. And the suggestion also being that you really did need your stop well below this D-print swing. And we did stop there again. We're seeing this a lot. This 29s through to, sort of 23 area. We're seeing the market continually holding here, continually pausing and stopping here. And that's what's led us further up the page. Overall, you would be saying that we've still got that bearish tone. Couple of reasons that we're looking at that being still mildly bearish, of course, is that we are below the K print open, which is important to us. And of course, this 65 high was our middle our 200-day moving average. And of course, whilst we're below there and closing below there, we are struggling to gain that upside momentum. Of course, the figures that are coming out are going to dictate the momentum that we're likely to see. The opportunity has been relatively few and far between. Perhaps just the one sort of, other than the micro scalping, perhaps just that sort of one area here where we could have bought into this dip. What's interesting about this is if you just look at the value areas, there's no crossover at the moment. So the volume value area has been entirely above yesterday's volume value area high. That is potentially maybe a slight warning sign that this downtrend is waning just a touch. Of course, VPOC not really shifting too far, just somewhere really in between these areas that we have seen recently. So the figures are going to dictate, of course, the rest of the afternoon moves. We're coming into this figure with a reasonable amount of anticipation and a reasonable amount of movement that has happened towards the end of last year. So reasonably important number, which we'll go through, of course, shortly. The Euro stocks has been doing nothing. It's been very, very quiet. I'd be surprised if anybody has attempted a trade in there. Now, of course, we were talking about the Euro. That Euro having given us the balance that we expected to see, or given us the move that we expected to see. That move entirely finished, entirely done. And what we did say this morning, and what we were mentioning this morning, is that this market is very, very likely to balance off. That's what we've done. Volume tucked nicely in between this sort of cavernous area here. Really, really filling it out. Pushed down, not far off of the TPO high, so that sort of 105.99. We're just down here at the minute, so a tiny little bit of dollar strength in this market at the moment. And of course, we've pushed back through some of these single prints and down to this area here. So again, the numbers are going to be pertinent to what we're looking for in the Euro. There wasn't really a trade that we were looking at. We are still mildly bullish this Euro. That's what we've been talking about. Certainly, so long as we're above, again, the D-print swing here, the midpoint here, we are having some bullish momentum, but in terms of the actual trade that we were looking for and the trade that we've been speaking about since Wednesday, that has come to some sort of fruition. So again, we've hit that target. We're now awaiting that secondary move. Having said that, the balance is what we were anticipating first off. Cable likewise has been incredibly balanced. Not a lot to do in there. I mean, it's a perfect replica of everything else that we've seen. All of the markets had that sort of afternoon breakout feel to them, and of course this morning we have come in and it almost seems like every single market has just filled in the sort of cavernous area that we were looking at. Again, still mildly bearish for now, the cable. A few warning signs. Like I said, we really need to build above here, get that close above there before we get a move to the upside. Otherwise, we are looking at filling this area and running down to some of those support levels. Overall, again, still sort of fighting in that middle Bollinger, but some big range contraction there at the moment. So you can see we're sort of rapidly sort of creeping in on each other. So where we lie now on that middle Bollinger, pretty well balanced, to be honest. Looking across at the S&P, well, it was another day where we didn't really do a lot. We've seen this so much before, these 10-handle ranges that the S&P does like sitting in, does like holding, so long as we're at these levels. A couple of things that just strike me as interesting. Firstly, we did hold that middle Bollinger yesterday quite nicely. We spoke about this coming in at 54.25. We held it very, very nicely. We had that recovery. Again, still very much looks like a flag structure. And, I know that the target on this is going to be monumental. You're talking this move from here was 200 ticks. Another 200 ticks takes us up to 2,500. It's absolutely staggering that, in the last few years, the wealth that has been created purely by buying dips in the S&P. I mean, it's an absolute shock. I think the only downside to that is I saw in some of the papers today they were extolling the virtues and the wonders of all the pensions because the FTSE was hitting all-time highs, and I think journalists do tend to be at the back end of the market, so look for that to be a high in the FTSE. But as we sit in the S&P, you can just say we held that middle Bollinger. We've got a flag type structure. Of course, the reaction to non-farm payrolls is going to be interesting. If we do, I think we're going to move. We'll get into this in much, much more detail, but I think we're going to move with the number today. So again, a weaker number could see us just unravel a touch and see some of this Trump enthusiasm is what this is. Just come out of the market a touch. Of course, a strong number. Again, you could see the exuberance continue and the S&P carry on. Again, it's hard to talk about the 10-year without talking about the overall effect of Donald Trump and this number on the market, but get the long-term perspective in mind because it's important when we talk about the figure, which we will do in a minute. It's important because what has happened is Donald Trump has been elected. The market was scared for about 2 hours, and then they decided it was the best thing for America since the last US president. And of course, there was worry about inflation and super growth and the American way coming back, and you saw bonds under an awful lot of pressure. All of this bond pressure, all of the S&P rally is all about Donald Trump's enthusiasm. That's, excuse me, that's what it's about. That's what the market has been doing since November. It's all been about that. Now, we've had a small relief rally at the moment. There's been a bit of slight souring to the occasion. A little bit of souring yesterday, and the ADP number and the employment part of the ISM. So we've just a little bit of that enthusiasm has just started to come back out of the market. So the S&P slightly underperforming, but mostly, the full move and the full extent of, targets being hit in the 10-year. Now, we were mildly bullish the 10-year. We were speaking about this. We were looking for some good pullbacks. We got a good pullback. So long as we closed above this middle Bollinger, we were bullish. Our target was here. So again, 2 swing trades, 2 for 2 this month. You're welcome. I'm only messing. But we've had 2 really good swing trades that are both at target. Now, the difference is, of course, the market is likely to move over non-farm payrolls, so you can't take too much out of, and expect too much balancing in terms of the 10-year today. But you can see that, yesterday we opened, we didn't really get too far down. We sort of held this gap that was here, and then we started pushing aggressively up the page. We've come up and through these areas here, up through some of these levels, sort of tagging this VPOC, tagging this close up here, and showing that little bit of strength just creeping into the market. There were a couple of good trades along the way. The F prints, you can see the 27s held as a high for a short amount of time before backing off and then pushing on through. Of course, the G prints held the single prints as well. So even selling into the resistance, that's what I was trying to say yesterday. When you get these double distribution days, and if you can identify that the double distribution day is on, then you've got no real concerns of necessarily going against the trend, because what you're looking for is the market to balance off and show you that early sign of balance. Then it has a fundamental shift, it breaks out, but you've got the conviction that the market is likely to drift back into a secondary form of balance a little bit later on in the afternoon. So we held these levels, although you would have been going against the trend. We're currently still very high. We're looking at opening up at the top end of this, and of course the figure will dictate where we go from there. Just interestingly, I've got the 2 different charts. I've got the pit only and I've got the all sessions. Just be aware that all sessions is just showing a blowout sign at the minute, so showing that there is a move coming, and that it is highly probable it is going to be to the upside. Of course, I think a very strong non-farm payrolls could sour that, but that is what is being indicated in our all sessions daily chart at the moment. You can just see the way the Bollingers are just widening up a touch, and especially the way we have held the outside Bollinger gives us an indication that we could shift higher. Of course, there's plenty of levels along the way. You've got plenty of areas. Not only are we talking about this sort of breakout point from here, but we've got gaps further up. So you should be able to find some really cracking levels. Now let's talk about the number. Non-farm payrolls. For December, the month of December, we are expecting, at the moment, the consensus is 175,000. It previously came in at 178,000, so we're not showing signs of a massive change. And the range on this is 125,000 to 221,000. That's your important headline number. We do get private payrolls as well. 170,000 expected, 156,000 previously, with a range of 136 to 241,000. The unemployment rate is actually expected to tick up a touch to 4.7%, having previously rested at 4.6%. The range on this is 4.5 to 4.8. Your monthly average hourly earnings are expected to be relatively inflationary. They are expected to be a growth of 0.3%, having previously contracted by 0.1%. The range on this is 0.2 to 0.5. Now later on after this we do get durable goods orders. That's the final number. It's not expected to move or deviate from minus 4.6%. And also at 3 o'clock we also get factory orders, which is expected at minus 2.3% for the month of November, and it previously came in at plus 2.7%. But all eyes will be on that non-farm payrolls number. As I've said, expected to be 175,000. That is your key headline number. Now, we are, as I've said with the 10-year, pricing in a slightly softer number. Now, this is on the back that ADP was slightly weaker. It came in at 153,000. That was well off what was expected, the 175,000. The manufacturing data, or the non-manufacturing data, also showed a little bit of weakness in the employment component. Now, given what has happened, and again, saying that unemployment rate expected to tick up a little bit. So given what has happened coming in recently, we have got the Donald Trump trade on. The exuberance, the enthusiasm. The S&P has skyrocketed. The 10 years have come off. We are expecting the era of Donald Trump to be pro-growth, tax reform, inflationary stuff. This is why the market has been drifting lower in the bonds and that growth sector, the stock sector. That is where all of the exuberance has been showed, and that is where the market is priced in. Now, we have slightly unwound that, but we haven't. If you look at this 10-year chart, we have come off from 129.23 all the way down to 122.18, and we are at now 125.00. We haven't recovered even 50%. If we just pop our Fibbo on here and we take it from this top here running down to here, we haven't even got close to the 50%. We haven't even got to the 38.2. So this market is still weighted down quite a lot. Now, if this number is not as strong as the exuberance has been forecasting, as the SPOO has been forecasting, as the inflationary bond market has been forecasting, then you could see a bit of a reversal here. Okay? That is what we're looking for. There is a lot of optimism that is priced in, a real growth for the Trump administration, looking for him to deliver that fiscal stimulus, looking for things to push through. And if the jobs report is a bit weighty, if it's a bit disappointing, if it doesn't help with that exuberance and it doesn't push that exuberance continually through the market, you're going to start getting worries. You're going to start being worried about how long it's going to take for him to push these reforms through, how long it's going to take for the stimulus to kick in, how long it's going to take for these tax reforms to come in. And the sentiment will change slightly. There's also an article saying that the dollar got hit overnight, and that sentiment was still in the market because there was a congressional hearing on cyber spying, and it did highlight, or they're saying that it did highlight, that there was reasonable disagreement between Donald Trump and Congress, and they're not going to be comfortable with that. Politics in Washington certainly delayed an awful lot of what Mr. Obama was attempting to do. It got things very, very hampered down and stuck, and the exuberance could just drift out of this market, if that feeling is that A, things aren't quite as good as is seemed, and B, that these politics could, put a bit of a brake on what Mr. Donald Trump is attempting to push through in his his fiscal stimulus. So that's what we've got at the moment. That's why I think that the number is going to go forward. If this number does beat, of course, the last little bit of pricing that we have seen should again come back out of the bond market. So I think for me, it's a relatively straightforward number. I think if you do get a disappointing number, I think this trend that we've got, this very short-term trend, is set to continue. I would look for targets, just small above at 09.5, of course, on that Fibonacci, and then you've got your 50%, and then you've got some of these gaps in here. So, really looking for this move to get us up to somewhere around that gap, the 126.16.5 area. I think a weak number could still continue to get us on the way, and of course a strong number will allay some of those immediate concerns that seem to have just dribbled into the market a bit, and should see us come back to where we sort of were sitting sort of yesterday and the day before. So again, your target really would be in this area here, this high volume node, this middle Bollinger Band. The same for the S&P. Again, if you do get that strong number, I do feel the S&P is going to continue its march up the page. I think if you do get a particularly weak number, then again, there's a lot of exuberance that has been posted in, from this area. So I would be looking for that to sort of contract and come off a little bit. It'd be very, very interesting what happens at this first Bollinger, this 22.33. That'd be amazing to see what happens there, because of course a move down, that will be the first time that we've touched that since November on our pit session daily chart. It's a trade I love, it's a trade that we do teach here, so it'll be very interesting if we get that weak number, whether that could hold us at bay. I don't expect a complete return back to these levels in the S&P. I think the S&P is always there to certainly be a dip buying type scenario, so I would be looking for that trade. Alright guys, well that is probably well enough of me. I hope that's all very clear and helpful. So we've got about 14 minutes until the cash open of the 10-year. We've got 24 minutes for the non-farm payrolls number. I wish you the best of luck with that figure. Of course, I will be back again next week, Monday at 7:30. In the interim, the course is getting ever closer. It's a week on Monday, the 16th of January. If you are still interested, we can always make space for you. It might be a little bit tight because we are busy, but if you are looking to join us, then please get in touch on info@futexglobal.com or hit me up on Twitter, my personal one, or of course use @Futex Live, Facebook or Twitter, and someone will get back to you there. Until then, I bid you happy trading, and as ever, please trade professionally.